Hi everyone, my name is Barney and I'm one of the founders of Vega Protocol. Tonight I'm going to take you through a sort of summary of the vision of Vega and how we fit into the emerging decentralized finance or DeFi stack, take you through some of the things we're building, give you a demo of what we built, and then give you a little bit of an opportunity to answer some questions. So the first question is, what is DeFi? What is decentralized finance and why does it matter? So what is it? It's built on Bitcoin, Ethereum, other blockchain technology, decentralized technology like IPFS, and it's an open ecosystem of protocols, of companies, of people that are aiming to challenge the financial status quo. And that's a really, really huge thing to try and do because there's a huge amount of money in it and a huge amount of power, a huge amount of structures set up that make it difficult to challenge. But the prize for success is also massive. At the moment, every time we transact in many ways, whether it's making payments using our cards, whether it's using insurance or derivatives to hedge our risks, whether it's accessing banking services or making investments and savings, every time we transact at the moment, we're giving money to a group of individuals and a group of institutions that have got themselves into a privileged central position in our financial system. And the thing about these organizations is that the price of doing business through them is not based on the costs they really have. And to give you an example of that, I did some work as a consultant for the London Stock Exchange. And at the time, they had something like 30,000 stocks that were tradable. And they run the entire matching engine and the entire exchange on 6 servers. Now, you look at the profit and the revenue of the London Stock Exchange, how much money they take out of every transaction done between investors, between savers, between companies, between individuals, between businesses, and you look at that profit, and you look at the cost of running 6 servers, and you say, is this a reasonable amount of money? If I was selling you TVs, would the profit margins on my cost for doing that be anything like theirs? Of course not. So the money these organizations take out by being in that privileged central position is huge, but they also make it really hard to innovate. They mean that there's a central set of organizations who you have to convince to trade new products, to sell new services, and to participate in the financial system. And even as we've seen with banks like Monzo coming along and shaking things up a little bit, when you can get in there and you can push some of those guys aside and you can build new things and you can open APIs and products up to the wider world, there's an opportunity to innovate much faster and much more cheaply. So the decentralized finance movement, if you like, is lots of companies now, all building protocols and networks and open systems that are designed to connect together and allow us all to trade more fairly with each other. If I want to do business with you, I should be able to talk to you, I should be able to design a product that meets my needs with you, and I should be able to trade it at a fair price, and anyone else in the world should be able to join us and trade that too. And that's the sort of decentralized finance overview. And this is just a very sort of high-level sample. There are many more companies than we're showing here, but just to give you an idea, there's lending systems, there's payment systems, there's exchanges and swap-based systems, there are data companies, and obviously, like Vega, there are derivatives companies, and all of these things together will integrate together and will create what eventually becomes a sort of parallel new financial system that's fairer and more open. And it's a real principle of this system that is, rather than try and capture the entire of an ecosystem or sort of build a walled garden, what's happening in this DeFi stack is that people are opening up and saying there's more value and there's more power in composability. There's more value in me connecting DYDX to Vega to OX and getting the data out via Factom or using Oracleize for an Oracle and then trading those things across a 0x protocol or using Bancor to move tokens around. There's more power and there's more value in doing that than there is in keeping everything to oneself, and that's what will sort of power the eventual success of this system. So where does Vega fit in? Well, at Vega we're creating a protocol and a platform for decentralized derivatives. And that's a huge undertaking, but it's a really, really key and important part of this system. And if you look at the financial system today, you have your retail products, and then you have your kind of investment banking and your non-consumer products, and that's really split between trading real things and assets, trading them amongst each other, and then a huge, huge universe of things that we call collectively derivatives. And actually, everything from sports betting to options trading to futures trading to insurance are all forms of derivative product. And what that means is they're financial products where each party has payments and obligations. In insurance, you pay a premium, and if things go wrong, you receive a payout. In futures, it's much simpler. You agree to buy or sell something in the future. But the key point here is that these are all products which are not actually buying or selling the original thing, but buying or selling a contract based on some kind of underlying thing or some kind of set of underlying things that allows you to take a view or to hedge a risk or to get some exposure that you would like that you otherwise couldn't. And so that world of derivatives is huge, and it's our goal to build a platform that lets you express all of those kind of products, lets you trade them in a completely non-custodial, decentralized way, and also lets you do that in a safe way. And by safe, I mean you pay margin, you have appropriate risk algorithms that mean that you don't end up in a situation where you are out because your counterparty can't afford to pay you what they owe. And that's a really important part of derivatives that's very different to a straight decentralized exchange. So how do we do this? Well, firstly, it's about standardizing and automating trading. As you know, blockchain-based systems, they're unattended. There's no one person running the network, and indeed there can't be. So to turn this into a protocol, we have to standardize every part of the trade lifecycle, from how you come across prices, to how the products themselves are executed, and even how the products are written and defined, through to how those products are eventually settled at the end, and how the risk management works. If you standardize it from end to end, right from the beginning to end, you can automate it. And the other important thing you have to standardize is the governance. If you actually want to be fully decentralized, and you see a lot of platforms sit around and say we're a decentralized exchange, and you say, okay, so who decides what's listed? Well, we do. Well, that doesn't sound too decentralized to me. It's definitely, the trading can be decentralized, but you also need to decentralize the governance if you want to create that permissionless innovation. If I want to give anyone on earth the ability to trade with anyone else in something that they want to trade, I need to decentralize the way that products are specified, the way that markets are approved and created. And finally, the other thing we need to do is to create a way for people to define their own products, because you can make a good start by taking some basic products like futures and options, and indeed our first release will do that. But in the future, what we want to allow is community members to come up with their own products, or their own spin on existing products, or their own combinations that combine an option with a future, or combine sports betting with futures, or whatever crazy thing they want. And the important thing is that process should also be permissionless. That shouldn't require us to do a new code release. So eventually we'll have a language, you can think of it as like the solidity of Vega, which will allow people to specify how a product calculates its cash flows, how it's settled and how it works. And then the Vega risk engine and the Vega protocol will allow people to trade those, be margined, be risk managed, and eventually settle those products. And so this creates a platform where, for true permissionless innovation, where anyone who wants to trade with anyone else can get together, can create the markets they want, can be rewarded for providing liquidity and incentives in those markets, and can trade. So as I mentioned before when talking about decentralized finance, it's all about connecting people together. It's all about giving people the same access. So the access is low cost for everyone. Realistically, when you look at fees and when you look at the marketplace for feeds and node producers, over time, the amount that node producers take out of the network will stabilize as a percentage of the amount of trading going on, and it will be much closer to the cost of running the nodes plus an appropriate reasonable stream of income, think of it like a bond or something, than it will be to being able to grab a huge portion of the trading value. And that'll be done because it's a marketplace. There's no single institution who can be a gatekeeper to that access, but anyone who wants to run a node will be able to do so. And eventually the competition for doing that and the competition for owning the tokens that give you the stake to do that will eventually allow people to compete that price down and get you the lowest fees possible. Real-time market data is freely available to everyone. At the moment, you can get the price 5 minutes delayed of a stock on the London Stock Exchange very easily. If you want to know all the orders on the book and the amount of data and the tick-by-tick history, you have to pay a lot of money. We don't think that's super fair either. What we'd like is everyone to see everything, and indeed by using a blockchain, we allow that to happen. Same with innovation. Innovation happens in the open. If you think there's a good idea for a new product, that proposal will be visible on the blockchain. It'll be active and live for a while before it actually becomes an active market. Others will be able to respond. They will be able to propose counteroffers or other alternatives, and the community and the token holders will be able to vote to decide which markets get created and which ones fall by the wayside. And so Vega really is designed, as we think of it, for the sort of next 10,000 markets. Yes, there's some benefit to sort of doing what's there better, but there's also a huge world of underbanked individuals and institutions and companies who don't have access to the same markets that we have here. And you look at the world of farmers, the world of commodity producers, the world of exporters who can't hedge their currency risk, they can't hedge their weather risk, and where we would have access to those investment banking and commercial banking services, and you realize the number of markets that could exist that don't yet. And those are the markets that we really think is going to make it very interesting to use Vega. So yes, as I mentioned, faster, cheaper, better versions of existing markets, but equally some of the existing markets, as any of you who've worked in a sort of markets type of role will know, some of the markets like FX and equities are extremely efficient. Actually, globally, the speed at which those trades happen and the cost for many of the players are quite low. And so, the best and first benefits to Vega are not in shaving off another percentage point for those people, but actually in looking for the underserved areas, the long tail of products that banks and investment banks and exchanges don't think it's worth creating, and new markets driven by permissionless innovation. There are probably product ideas out there which we've never seen and we've never thought of, and people will bring that to the forefront when they can do that sort of for free. So, when it comes to using Vega, we've got to think about it as a number of different levels and a number of different ways that you can use Vega. Obviously, the first one is the easiest. You use Vega as a trader. You decide, I want to trade something, there's a market there, off I go. Provably fair, same rules for everyone. So the white paper will be out there on the website. It's not actually live on the website yet, or there's no good reason for that, so it probably will be quite soon. But if anyone wants it, please let me know and we can send it to you. All the rules will be published, and all of the outcomes of all the decisions made by the network will be visible to everyone on the blockchain. We run a completely decentralized order book. So this is sort of full DEX for derivatives. We're built on the back of Tendermint, so we get 1 second latency. And I think we've tested up to sort of 10,000 orders a second in bursts, and we've held 4,000 orders a second continuously. So we're getting really, really good throughput and speeds, which is very, very important for trading. You need to have a reasonably responsive sort of price feed, if you like, and a responsive market. Otherwise, you can't respond to changes in information. And also, it's really important, professional grade trading UI and APIs. And so, if you think about interacting with something directly via Ethereum smart contracts, you have quite a fiddly API. It doesn't provide you with aggregations of data. It doesn't provide you with streaming data. It can be quite a pain to work with. And building trading applications, integrating with funds and market makers and with your own other software can be quite challenging. We are taking a different approach to that. And as part of our Vega node software is an API which allows you to access and sort and play with that data in many, many different ways. It gives you GraphQL, it gives you a whole bunch of other things. So next up is making markets. Anyone can be a market maker on Vega, and the Vega protocol itself includes a way of giving rewards to market makers who commit to providing liquidity. This is absolutely key. If we're going to allow market creation to be decentralized, then we need a way to ensure that there is actually liquidity. The worst thing would be to have 10,000 markets with no liquidity, with no prices, and with no trading. And so there are kind of two conditions that have to be satisfied on Vega for a market to be created. Firstly, it has to pass the kind of stakeholder or token holder voting. And that's really to ensure it's not fraudulent. It's to ensure that if it uses Oracle feeds, for instance, to settle, it's based on a reliable and trustworthy feed, and it's not going to do anything weird. But it's also to make sure that people aren't creating unethical markets. So if the community look at bad types of market that might exist, where people are selling something that the community itself doesn't judge to be something that should be traded, then that can be shut down by the community in their voting. And obviously the incentive for the community is to do what's good for Vega as a network, for its reputation and for its increase in trading because of the way rewards are distributed. But the other thing that has to happen for a market to be created is that liquidity providers have to be rewarded in such a way as to attract them to these new markets, to make sure that there are orders on the book at all times so that you can always come in and trade on those markets. And so Vega effectively shares a dynamic amount of the fee, and in fact the fee size itself is dynamic, with market makers. So when you commit to being a market maker, if you're committing in a market that has a low amount of liquidity and that could do with more based on its historic trading activity, based on its open interest, then your fee revenue will be much higher. If you commit to being a market maker in a very liquid market, let's say Bitcoin, US dollar, and there are already tons of market makers and lots of orders on the book, the fees are going to be lower and the revenue you're going to get is going to be lower because it's going to be deemed a market that needs the liquidity less. So market makers will be able to make more money by sort of looking at the marketplace of liquidity offers and going out there and making markets where it's needed. Those liquidity incentives keep the market safe. For the market to be safe, we need to be able to see that someone is approaching, using up all their margin when a trade moves against them, and we need to be able to close them. We need to be able to close their trade before they owe the network more money than they have. Because otherwise, they owe the network more money than they have, and that means that someone is on the losing end of the trade. And with no organization or institution running the network, that means the other traders are on the losing end. So it's really important that we have liquidity incentives that attract the liquidity and allow us to close out traders as they're in too much of a losing position. And And finally, passive market making. So, we have the idea that you can actually participate in market making with collateral, even if you don't understand how to be a market maker and even if you don't have any algorithms. Now, this is similar to a combination of sort of following what other market makers do and platforms like Bancor, where effectively prices can be calculated algorithmically from what other information we have in the sort of case where there are no active market makers on the book setting prices themselves. And by doing that, we do two things. We provide another route to get liquidity in and to keep markets liquid and moving and keep them safe, but we also provide a way for participants on Vega who have collateral that they're not using actively to trade to receive an additional stream of return, effectively, to put that collateral to work and receive interest for a balance that they have deposited with Vega and are not using. And so that's a really, really interesting thing to be able to do, because it gives you an all-in-one solution, not only to trade, but to actually use the cash that you've got on hand as well. And then building on Vega. And this is where it starts to get really exciting, because once you've got these markets, once you've got liquidity, once you've got the ability to create these products, and once you've got the ability to do that in a safe way, but also a capital efficient way. We don't want to have to tie up the full potential loss just to make a trade. We actually want you to be able to tie up the smallest amount possible whilst keeping the market safe. And once we've got this, then there's a huge amount of opportunity to connect Vega into all of those other companies that we talked about earlier. There's an opportunity to wrap positions in an ERC20 token and trade a position that you created on Vega across a token, and then move who gets the return from that position between people, just like any other token. There are opportunities to integrate with protocols like OX, or to integrate with Oracle protocols, or any of the other protocols out there. And we're just at the beginning of this journey, and in the Vega roadmap, what we really want to do is get the platform and the trading and the liquidity provision live and working. But over time, it's not going to be that sort of stands up and makes Vega super successful. It's going to be the ability of Vega to be a first-party player in this new ecosystem, and to actually connect to all these other types of protocol. And I listened to the guys talking about Argent earlier, and I saw a number of ways where the way that the Argent wallet is designed, or the way they do logins, could integrate and extend the capabilities of something like Vega, or where Vega could be useful for some of the things that they're proposing as well. So there's a huge amount of innovation in this space, and we really think it's very interesting to see how Vega can become a core component of a lot of different products and services. So that's an absolutely key part. So now I'm going to try and do a little bit of a demo. This was working earlier, so hopefully it's still working now. And this is what we kind of call our sort of reference client, reference trading UI. So this is Vega as it currently looks. It's sort of a pre-alpha, but as you can see, it looks a lot like an exchange. Just to sort of explain to you a little bit about what's going on here. This is basically a static HTML and JavaScript bundle that's hosted on a Netlify server. There is absolutely no back-end server for this at all. So it just sends the HTML and the JavaScript application down to my laptop, and then what you're now looking at when you see prices moving, when you see the order book status changing, is data coming from the API that's running on one of our nodes. So we're running a development network with 3 nodes, one in London, one in San Francisco, and one, I think, in Hong Kong. And that network's running 3 nodes, running a blockchain. And as the blockchain makes blocks, it's running the DEX, it's creating positions, it's valuing the positions in their P&L, and it's also sending streams of this data via a GraphQL API down to this trading engine. So you can see I can enter an order here. Let's attempt to buy at 5 below the market. And what we should see is the buy order submitted, and that's now on the blockchain, that's got an ID, and that's now waiting, and if the market drops by 5, then it'll purchase, and then you'll see more fills turn up in here, and you'll see the open position change. And equally, if I'm at 5 below the market and I hit sell, what you'll see is the order goes there, and as soon as it confirmed, that disappears, and you've got a bunch of sells. So as you can see, for a decentralized exchange, certainly there's a lot of responsiveness in the UI. There's a lot of rich data. We've got a market depth graph that's updating as trades occur. We've got a market depth there. We've got some charts. And a feature which the UI guys have built this week, and I absolutely love, and anyone who's been a sort of, whether seriously or as an amateur, anyone who's traded in the past and got really into it and decided they want like 6 screens will really love, is we've got these workspaces. So you can set up your UI exactly how you want it. You can move everything around, you can add as many graphs, open as many things at once, and then you can open multiple windows. And on different windows, you can switch. I've got a workspace called Charts Everywhere, and now I've got 4 charts up that I can keep on another window, and I can create a new workspace very, very easily. And I can decide what I want to see. Maybe I just want to have one chart here and set it to the 1 minute view. And then maybe I want to split that and just add my open orders. Let's have my open positions. And then I can drag that and I can stick it on the bottom. And this is completely customizable. You can move it around, you can do as much as you want, and you can create all of your trading layouts, you can create them for many instruments, and you can just go to town on that and set up your workstation how you want it for serious trading. So that's kind of the demo. Just to give you, as I mentioned, we have a sort of three node network. I can't remember how many orders a second we run through it most of the time at the moment, probably a few hundred orders a second by default, but we sort of pump it up to a few thousand when we want to test things. The current limitation is how much we want to spend on AWS boxes, because if you do 4,000 orders a second and try and store all the historic data on disk, you end up paying for more and more disks, and AWS disk space isn't super cheap. So for now, we kind of clear the history every week or two, just on the developer net, and once we put the first test net live, we'll start running it for longer and longer and start to get a real history there. So yeah, that's just a quick demo. So now just to go through quickly the roadmap for Vega. March last year we had a proof of concept. We basically attached a very, very basic trade matching engine to Tendermint blockchain with some sticky tape, and as long as you didn't look at it for too long or want to store anything to disk, it continued to run and prove the thing could work. Then sort of around the middle of last year, we had turned that into a sort of fully working prototype with real trades coming out and blockchains running for a few days or weeks at a time. And then September last year, we finally finished integrating Badger. Vega's written in Go, and we're using Badger data stores, a very fast key value store. We finally finished integrating that for all of our persistent non-live data, so that you actually have a historic data that can be backed up to disk, and so that allowed us to run for longer than the amount of memory in the machine. Then in April, we're going to launch our first network, and if any of you guys want to be part of it, please come and talk to us. We'll get you on the list, and we'll make sure you guys can join early. The first test network we're calling the Nice Net, because we won't have done any security testing, and we won't have done any testing for being able to game the system, and we won't be fully ready for a lot of those things, so we want everyone who's using it to be nice to each other and not attempt to break it. I mean, you can attempt to break it, obviously, but the goal is not for people to try and be testing the security there. It's really to be testing the APIs, the UI, the protocol itself. And over time, as we approach Q3, we'll end up with a full test net, which will be supposedly feature complete, ready for mainnet go live. And that goal is so that rather than wait till we're here and we've got everything, we start getting iterative feedback on what we have built as soon as we're ready to get it in front of the community. We want to build out in the open. Once we get to this full testnet, really the goal is to go from full testnet to mainnet as quickly as possible, but whilst being safe, because you see what happens to people like the DAO, things go wrong for you, and everyone's money is lost and no one will ever use you again. So really for us, the full testnet to mainnet is going, let's feature freeze, and let's find and fix bugs, let's find and fix security holes, and let's do audits and other types of testing, many different types of testing, as many as we can think of, really, to try and minimize the risk that when we go to the mainnet, we have something catastrophic. When we do launch the mainnet, it'll be an alpha, and some of the things around that alpha are perhaps instead of trading true Ethereum, you'll swap Ethereum for a token that we create at the door, and that will allow us to kind of audit what happened on the network at regular intervals and actually check that someone hadn't attempted to steal all the money before giving them their real Ethereum back. And that allows us some ways to use the alpha, which is still decentralized, still runs a decentralized protocol, but provides some protection for if things go wrong. And then slowly we'll take the training wheels off, and slowly we'll open up into a more and more public and more fully decentralized network, until sometime in 2020 we have what we might call a complete decentralized mainnet. So that's really what we're planning to do. Thank you for listening, and any questions?
Any questions? Gary in the front. So I always love decentralised exchanges because what you're describing, the way that you've got installations in Hong Kong, the States and the UK, and you're allowing the ability of people to practically create derivatives onto financial instruments. So therefore you're falling within the remit of the FCC, HKMA, ESMA and KFCA. So how are you addressing the regulatory issues?
So we're still having a lot of conversations around that, and those conversations are with regulatory lawyers, with regulators themselves, where they will engage. And there are a couple of things that we want to look at on that. And so the first thing to think about is we're infrastructure rather than actually doing the trades ourselves. You know, we are not running a centralized network. We're not overall, and no participant is overall in control of that. And so the scheme we're actually looking at is that the regulatory requirements are attached to an order rather than the network. And what that means is that if you're a participant in the UK, I can't remember the name of the company, there's a company, I forget the name, but there's a company, for instance, who are issuing a non-fungible token attaches to a wallet that allows you to prove that KYC has been done on the contents of that wallet. Now what we're looking at is things like that. So I can basically get approved by any number of regulators or approved bodies to say, you know, I'm FCA regulated, and I get some kind of cryptographic token that says this account, this wallet is FCA regulated. I would now submit orders and say, instead of anyone can trade with this order, to trade with this order and to create a trade with me, you also have to be FCA regulated. And so rather than creating, you know, one pool that sits within one jurisdiction or attempting to create one pool that sits within every jurisdiction, what we actually say is every order submitted by a participant sits in a jurisdiction or a set of jurisdictions that participant sits in. And that allows you to have lots of overlapping pools where no trade will ever happen between parties who can't trade with each other for a compliant way. Now, there are some things that you have to do to get that all to work. You know, there's a number of industry associations there, and you need to get regulators to agree that they understand and accept how that works. You need to get auditors to understand. And, you know, initially, let's face it, we're going to do what all the crypto exchanges do. We're going to run the initial operations out of a jurisdiction that doesn't require what's going on to be regulated, and we're going to have it for people trading crypto with other crypto people who are okay with that. But in order to do some of those things we talked about, in order to make things cheaper for real business people, we need to make sure the crypto on-ramps are there, and we need to make sure the regulations are there. So, you know, it's an approach like that where everyone sort of says, this is my jurisdiction, these are my regulatory requirements that must be met to trade with me, and then there's an audit trail on the blockchain that proves that's been met.
Any other questions? Stuart, back.
So who's your target user? Is it me? Is it hedge fund? Is it BlackRock? All of the above? For example, if I want to be a market maker, presumably could I be a market maker in something exotic like the weather?
Absolutely, yeah.
So for example, I'm a market maker in the weather, and there's a 3 standard deviation event, a 3 sigma event. There's a massive storm. I clearly can't fulfill my obligations. What happens then?
Absolutely. So the way the system is effectively designed is that to create a market in the weather, there's going to be a risk model that needs to be attached and calibrated. And what that means is that the risk model needs to know what type of product it is, but the type of product might not tell you much. It could just be a binary derivative that could be based on, was there a more than magnitude 5 hurricane within this month? If that's the case, there's still a very difficult to assess and very high risk. So the calibration of that model is going to be super important. And the requirement for margin that goes into a position is going to depend on that calibration. And what we'll end up finding is that if there is a high chance that someone could be wiped out based on what's in their account, that calibration is going to require more margin. In future, what we may find is that you may want to create markets which are restricted membership to institutions that can prove they have the capital backing to allow people to trade on margin. Initially, what would happen is effectively the calibration of that marketplace might require a 100% collateralized position. Or if that's not possible, it might require a stop and a limit, stop loss and a take profit to be on every order, and that potential loss and profit to be 100% collateralized. So in the early days, we would do something like that, and it will all depend on the calibration of the model. In the future, what I could imagine happening is there are types of market where you have to prove some kind of collateral, or you have to hold some amount of money in custody somewhere in order to be able to market make on that market. So it does depend. Obvious. Does that make sense?
Yeah, thank you.
Any more questions? Right, how do you prevent people from front running the orders? Which is quite typical.
That is a fantastic question. It's an open area of research, but we also have some solutions that will work, and we have a couple of different solutions. And one of the things about Vega is the markets that get created will be configurable and be able to use a number of different trading modes depending on what's appropriate. In some cases, you may simply find that the fact that the node that's actually making the decision on any given block is kind of randomized, or you may find that because the amount of time that you can have access to that decision ahead of other people is very low, it may not matter. In other cases, there are more sort of concrete things you can do. So one is a two-step trading system. So you sacrifice a small amount of latency, so you effectively double the latency. What you say is in step one, everyone submits their encrypted orders, and they also submit bits of the key to decrypt them effectively to a number of the nodes. And that means that no one node who can see the encrypted order can do anything. And at the end of the block, in the step two, the nodes all share the keys they've got, and now they can decrypt. As long as, say, 70% of them or 66% of them have come together with keys, they can now decrypt the order, and then the trades can happen. But by that point, new trades for that step won't be allowed, so you can't front run. So it'll be sort of what you call a commit and reveal process, where at any point when you can see the content of an order, you can't affect the trades that happen in that block. So that's another way. There are a few other things, and actually we've got David, our sort of research lead. He's an ex-quant and he's at Edinburgh University. He's actually doing some research now on, among other topics, front running and other types of gaming in Vega, and we'll definitely be publishing some papers on that.
Right, and I guess it will slow down the orders getting executed, I guess. You put that sort of logic in.
Yeah, it would effectively increase probably double the latency effectively, because instead of having, you enter an order and then when that block is finalized, your execution happens. What's actually going to happen is when you enter an order, that block is finalized and potentially the execution waits a little bit to happen. So it would potentially slow things down. So like if you've got a second of latency, it could be up to 2 seconds. But again, the extent that we can minimize that impact and the ways that we can use that kind of secret sharing and commit and reveal technique with lesser impacts on latency is still something we're looking into.
I also love decentralized exchanges, and so IDEX and Radar and all these things I love really and think are brilliant. But interacting with them on Ethereum is pretty painful, getting balances onto them, getting balances off them, getting trades confirmed, getting the order to work. So you're going to solve all of that. It's all going to be much faster and more seamless. That's basically what you're saying.
Absolutely.
And on your own protocol, not on Ethereum.
Yeah, absolutely. And there are limits to what we can do. So if we're interacting with if you're using Vega via an app that's connected via Ethereum, you're going to have the performance guarantees of Ethereum because that's the slowest part. And again, if you're using Ethereum tokens, so funding a Vega wallet with ETH is going to require an Ethereum block to settle. And so that, that funding with ETH is still going to happen. Maybe we can use something like Argent or one of those type of things to make it at least a better UX to do so, but ultimately that funding settles at the speed of Ethereum. Once that funding is settled with Ethereum, once the Vega protocol and the Vega nodes can all see that you have that money in your wallet, you then happen at the speed of Vega. And the speed of that demo, 1 second latency, there's none of this sort of clunky wrapping things. You enter an order and a second later you get confirmation whether it's on the book, whether it's filled. So yes, it's not as fast as getting 100 times a second responses from a centralized exchange, but as a user, and we use this every day all the time in test, as a user it doesn't feel it doesn't feel bad to use, and it feels like a real trading platform.
So once you get into the Vega sort of walled garden, you're done.
Exactly. Once you're on the Vega network, exactly. So all the Vega transactions happen, every second. You get blocks every second. So when you submit orders, cancel orders, amend orders, become a market maker, withdraw market making stake, anything like that, that all happens. It's all with a good UX, it's all with a good UI, and it's all much faster. But getting in and out, obviously, is going to require an interaction with a slower blockchain.